Dear students, welcome to my channel, Dr. V.R. Pudili, Professor of Management and Economics. In this video, I am dealing with meaning of operating cycle, need for working capital and operating cycle, and calculation of operating cycle. Operating cycle, the continuing flow from cash to suppliers to inventory to accounts receivable and back into cash is called operating cycle. An operating cycle refers to the time it takes a company to buy raw materials, convert them into finished goods, sell them, and receive cash from the sale of said goods. In other words, it is how long it takes a company to turn its inventories into cash. The operating cycle, also known as cash cycle of a company, is an activity ratio measuring the average period of time required for turning the company's inventories into cash. This process of producing or purchasing inventories, selling finished goods, receiving cash from customers, and using that cash to purchase or produce inventories again is a never-ending cycle as long as the company remains in operation. There are generally three phases in operating cycle. 1. Conversion of cash into inventory. 2. Conversion of inventory into receivables. 3. Conversion of receivables into cash. I had explained different phases of operating cycle with the help of the figure given in this slide. We can observe that with cash, we purchase raw materials, and raw materials will be converted into work in progress in production process, work in progress again converted into finished goods in production process, finished goods after sales become accounts receivables, and accounts receivables will be converted into cash after realization of income. Need for working capital operating cycle. If it were possible to complete the sequences of operating cycle instantaneously, there would be no need for working capital or current assets. But since it is not possible, the firm is forced to have current assets. Since cash inflows and outflows do not match, firms have to necessarily keep cash or invest in short-term liquid securities so that they will be in a position to meet obligations when they become due. Similarly, firms must have adequate inventory to guard against the possibilities of not being able to meet demand for their products. Adequate inventory, therefore, provides a cushion against being out of stock. If firms have to be competitive, they must sell their goods to customers on credit, which necessitates the holding of accounts receivable. It is in these ways that an adequate level of working capital is absolutely necessary for smooth sales activity. In this slide, I had explained the procedure of calculation of operating cycle. Following steps are involved in calculating operating cycle. Step 1. Determine the inventory period. Inventory period refers to how long a company holds its inventory. Inventory period is equal to 365 divided by inventory turnover. 2. Determine the company's accounts receivable period. Accounts receivable refers to the amount of money a customer owes a company. Accounts receivable period is the time in which the company collects its receivables. Accounts receivable period is equal to 365 divided by accounts receivables turnover. 3. Calculation of the operating cycle. Operating cycle is equal to inventory period plus accounts receivables period. Dear students, in this video, I had dealt with meaning of operating cycle, need for working capital and operating cycle, and calculation of operating cycle. Thank you.